All right, so here's a process that kind of summarizes how we develop systems, how to make reliable systems. The first thing is this process of ideation. Is that a made-up word? I don't think it is. Ideation. Anybody heard that word before? I don't know if that's like something I just, yeah. So coming up with your idea. And there's two ways, one of which I'm going to say is an inefficient, possibly incorrect, but definitely, in my mind and in my experience, less likely to produce a good result. And that is to come up with your idea by pondering, okay? And just sitting back and thinking about ways that that you can come up with profitable trading systems, ways that the market moves, and just by thinking about it, coming up with ideas. In my experience, for myself and working with system developers and traders, that tends not to work. What works instead is observation. Thank you, people. Everybody's looking up whether or not ideation is a word. Observation. Okay, this is what we see on the desk. I was talking with, while I was up in the office for a month, working with head quant trader, another up-and-coming quant trader who has, I think, 7 live models on the desk right now, all from backtesting. This is the process they go through. They start with observing specific instances, and this is different than what I've done in the past, and I'm trying to come up with this myself, kind of go through that process. I want to see what that's like. I've never done that before. Very specific instances that they've seen where a pattern develops, a relationship develops between two instruments, whatever. And then they move from there. So what usually is not effective is to start at pondering. Okay? And when you start with pondering, you think about what might work. You say, well, I wonder if I took this indicator I've heard about and I were to do this with it. And then you go test that, or you start, even worse, even scarier, you start implementing it without testing it. That's really scary. Observation says, let me find something that's happened and review it, see how it unfolded, see where this move developed from, see what happened before that, see what was going on in the market, and really observe it carefully, and then go find other instances of that and find what they have in common. That is what the process, which has gotten live models on the desk, back-tested well, trading live, out of sample, working well, starts with you're observing and finding what actually is happening in the market. How does the market actually move? And that's important. So here, this is the one thing, ideation. Secondly, after you've moved to that part, you can switch colors just to kind of indicate we're on different things here. Here we go. You describe it. And when you describe it, deductive reasoning? Yeah, I mean, I don't know. That doesn't describe it to me, deductive, but more of observing to find things that actually happen instead of coming up with things you think might be true. So describing is a non-quantitative process. Quantitative. Okay, you can tell me if I spelled that wrong. You actually start with this. Some people will, and I've done this myself, and I think this is a mistake. I think it's inefficient, is to try to measure everything and see what works. That actually tends to be information overload. You get too much information, too many ideas. You're trying to filter through all of it, and you really aren't capturing a true edge from the market. So this process, however, says, let me observe the market. One of the traders, I think, tremendous amount of discipline. Let's see if he's in here. I'm guessing he's not. He's a busy guy. No. Okay. Very disciplined. He what? Oh, you are here? Very disciplined trader. He trades, his algorithms, his systems are looking for events, event-driven, news-driven type things. So he'll watch these things unfold, and he'll watch news, he'll watch earnings releases, he'll watch stocks in play, and he'll have them up on the chart, and everything, his screens are flashing, and everything's going on, and he has his hands in his lap, and he's watching, and he'll watch it all day, and then everybody else on the desk is trading it. And I asked him, I said, did you trade that today? He's like, no, I'm just watching it. I'm like, wow, okay, did you, any of your systems trade? He's like, no, nothing's built for this one. Oh, okay. So he's going through this very careful, long period of observing. How is this thing trading? What are the events that unfold? What is the setup? Where was the consolidation? How was VWAP moving? How was the market moving? What was volume like? All of these things, and he's just writing, taking notes. The head quant, he says he has a notebook full of pictures of examples of stocks and how they move that he plans to describe, build a script, test it, and then go test it on the entire market to see if it's a repeating pattern. So this is all about seeing what's actually happening in the market, and then the second step is describing it. And this is where you actually use words. You're not using math. You're not trying to find an indicator to reveal to you the secret of what just happened and repeat it. This is just describing. And this may sound like, if volume is twice what's normal, there was recent news, the stock is stronger than the market, it's trading above VWAP, it holds for 15 minutes, it consolidates for a period of time. So very non-exact things. Stronger than the market. What do you mean stronger than the market? Is the price higher than the market? Is it moving by more ATR? We're not worried about describing it with numbers yet. We're just describing it. Stronger than the market. And we're not we're not just coming up with a hypothetical scenario. You're trying to see a stock that had a very big move for the day, had a lot of opportunity in it, and describe it. Say what happened, what caused that. Say there was news, it was stronger than the market, or maybe you saw that the market was strong, that the move only occurred after the market started going with it. Whatever it is, you describe it non-quantitatively. And then you move into your quantifying. Can I zoom out or anything? I ran out of room. Yeah, whatever.
Rookie mistake.
Work on the side here. What? Say that again.
Rookie mistake.
Rookie. I know, rookie mistake. I thought I would be able to grab things and move it around, but it's not letting me do that. It's not Paint. Paint is superior. Quantifying, and this is the exact measurement, okay, of what you're looking at. All of this is just in the idea, development, quantification of an idea. Then you actually write your scripts, and depending on your skill level, the technology you have, the technology you know how to use, etc., most people will find that they have to get the stock information, put it into Microsoft Excel or Google Sheets or anything like that, and do the work from there. And that is completely valid. A lot of work is done that way. I make decisions and have made a lot of decisions in my trading based on work and research I had done in Excel, and that is very valid. I have other technologies now to speed that up and create automatic reports and things like that faster, and we go through that in the systems testing workshops. But this is fine. So you get the data, you start to measure it, and you start to see what is the expectancy of this idea. And this idea that I got from observing not just wondering if an indicator is profitable. That's not, that's, you're going to, if you, a lot of people go down that route, and I'm trying to encourage you not to do that. Instead of saying, I heard somebody talk about this indicator, I heard somebody promoting their indicator, I heard this guy says there's this correlation between this event and that event. Instead, go look at actual events that have occurred. So you're observing what's actually happening, you describe it to yourself in words, and then you go through a process of measuring it. You want to create the exact measurements and find, is there a positive expectancy in this idea? So I'm going to clear all that out and move on from there. At that point, all you have is some type of idea of an expectancy, and then you backtest. Backtesting can be done in Excel. Backtesting can be done manually. You can do it with Thinkorswim and their various tools, ThinkBack, On Demand, etc. Very, very common. TradeStation would be an affordable way to do directional backtesting of equities. OptionNet Explorer or OptionView will help you with your options backtesting. All of these things are valuable and important. But this still leaves the question that we sent out an email earlier this week saying, how do you know if your backtest is reliable? And this comes out as a question very often when we're showing a backtest, when we're talking about a system, is this question of, is that data curve fit? Have you gone through a process of data snooping? We've been through this in the systems testing workshop, and I'll do a brief description of it here. When you do a backtest or an optimization, you get a lot of results. Okay, so you backtest, you have multiple versions. So you backtest version A and version B and version C. And maybe that goes all the way to Z. Okay, so you have a lot of versions. If that comes back and all of those are based on the core edge that you are measuring that you think you've observed in the market, directionally, non-directionally, some type of edge, and you test all of these different versions, you want to see a large number of them be profitable, and it's okay if a few of them are not profitable. Okay, that's fine. What I have found is if I start without the edge in mind, I start with an indicator. I say, I'm just going to take this random indicator and I'm going to plug it into a random chart, a random symbol, and test a period of time on a random bar interval, so a random time frame. What happens is I can run an optimization and I can often come back, if I'm just looking for a good result, where I might see a handful of good results. This happens often. Go to red. And then a bunch of results that are negative. Okay, and this is A, B through Z. And if you haven't looked at all of them, but that's one example of, you can find maybe this version right here, version A or version B, had a really fantastic equity curve, does a great job, high expectancy in theory, but it could possibly just be a set of random results. I think, Merritt, I think you were there when we talked about you can go in Excel and create, and I won't spend the time doing it, but you can go in Excel and create literally a random set of values, and you can tweak it to have the smallest amount of positive edge, or you can make it just completely random. I've done this as completely random, so just randomly generate a number between -10 and +10, and then I let it give me 1,000 data points. So rows 1 through 1,000 all have the same code. Randomly fill this cell with a value between -10 and +10. Take them all, and then I create a chart of those values. And then I think it's F9 or F8, one of those two keys. You just keep hitting that key, and it will just keep regenerating random values in every cell. What will happen is you just pound the F9 key or whatever it is. You just pound it a dozen times, 20 times, whatever. And then all of a sudden, one of them will be perfect. It'll just have this beautiful, straight equity curve. Most of the time, it looks like this. It's just a very random return like this. And then 1 out of whatever number, 1 out of 30, will just do this with the same underlying edge to it. This is what happens when you optimize a system, you test the system, and you are not using a core edge. You're just saying, I just have an idea, and I'm going to test it, and I'm going to try a few different things, and then all of a sudden you come across one of these. You say, I found it. I've discovered it. I knew if I'd poke around enough, I would find something that works, and here I found it. But what could be is just like our example of non-market data that has no real edge to it, has no fundamental edge. You are probably just discovering something that has more randomness to it than core market edge. When you've discovered a real market edge, I deleted all of the drawings for, but by going through the correct process of, let's observe something and describe what is it about this that is a fundamental fact of markets. Why is there truly an edge here? Describe it, measure it, test it, then test a whole bunch of varieties and variations of it. And what you should discover is, if you have gone through this process correctly, you're going to find that many versions work. And we've done this a lot. In systems testing, we do this a lot. We'll run strategies. One of these that is a well-known edge, it's not a big deal. It's not like, there's plenty of volatility to it. It's not some great secret that we're giving away, but the VXX has a negative drift. So when you build short strategies around VXX, you do it with good signals, you could do it with good risk control. We often find that most things work because there's this fundamental market-driven edge in that. Then you apply a good series of risk controls, technical ways of getting in and out of trades, etc. You can create great equity curves. But almost anything you throw at it works. Just like market neutral options trading, many things work, but there's a lot of things that don't work as well. And you start to figure out how do I control risk better? How do I create positive expectancy? How do I find the safest zone, the best expectancy inside of a really solid market edge like this? Now, like I said, there's the VXX is one example of that. This is that negative drift from the roll yield of VXX, which right now is actually inverted at the moment, and that's why we've seen VXX kind of drifting up lately. But another trade that has gone through this process that we're very excited about at SMB is the HeartFriendly Butterfly that Seth Freudberg developed. So this has been something that's kind of been sitting on the shelves. He built this trade many years ago. He created a video series. He taught the trade. He's been a mix of ongoing forward testing and live trading of the trade. But what's happened is, over the last couple of years, he started by going through this process. He says, what is it that I fundamentally know about market neutral options trading? And from there, from his years of observation, his years of experience in trading different systems and testing different systems and observing the market, he says, he's come up with his idea out of an intimate knowledge of the options market. So he develops his idea, he tests it, the results are good. He didn't do the multiple variation testing. He really just came up with what he believed was the available edge. He tested it, it worked. And what happened, though, is years later, the exact version he came up with is still working. And this is what matters most. As a newer, unprofitable trader, we wrote an email earlier this week. The number one fear you have is that you won't find an edge that works at all. You won't even find something that will get you profitable. But even when you do become profitable, that same fear exists that what you're doing will end, the edge will go away, your ability to ride that will go away. And to alleviate that fear, you have to go through this correct process of finding an edge that will be reliable. So Seth's trade, the HeartFriendly Butterfly, has gone through this process, and it really has proven, it's very exciting to see that a faithful steward of the market, a faithful observer, somebody that respects the power of the market, that they aren't bigger than the market, they're not going to find any secret key to it, just says, I'm going to observe what's really happening, what the real available edge is, and I'm going to design something around that to control my risk and take advantage of that edge with positive expectancy, and then implement it. that has worked. It has worked out of sample. Talk about out of sample results, not historical out of sample. We're talking all of the analysis is done, and then the real world hits. It continues to work. We've re-optimized. We've worked with Quanti Carlo, who can do automated options backtesting, very complex process. And we've re-optimized, retested. We've tested thousands of combinations of the HeartFriendly Butterfly. We've second-guessed every last part of that trade as far as how many days to expiration, how wide of spreads, stop losses, profit targets, etc. Thousands of combinations over 10-year backtests, so that literally 10,000 plus backtests of the HeartFriendly Butterfly. The end result was very, very minor tweaks that Seth recorded. Our plan was to add on an entire bonus series, was probably to do hours more content around the HeartFriendly Butterfly describing the additional studies. He struggled to come up with 30 minutes of content around the changes because there were so few changes from that extensive study, because his original observation about the core edge, his original design and testing were so spot on from what's really going on in the options market, what's the available edge, what is the expectancy, how do you control risk. It was all so good about his understanding of controlling risk. What should be the risk reward of an options trade? How many days to expiration should an options trade be? How many standard deviations should the wing widths be? These are things he just knew about the options market that carried over, and thousands of tests after the fact, looking back in time, are not really able to come up with significant changes and improvements that we felt were reliable. There were some random results that were fantastic, but we realized it would be very difficult to trade, and we just saw that they don't really fit inside of this process of identifying the edge and creating a good system around it. So HeartFriendly Butterfly, we're very excited. We think this is going to be an amazing opportunity for options traders and also non-options traders or newer options traders, because it's a completely rule-based system. There's no discretion involved. It's a very low-frequency trade. You don't have to trade it very actively, so you don't have to be staring at your options profile and making adjustments or analyzing different possible adjustments and selecting them. It's just a very color-by-the-numbers, rule-based trade based on the edge of the market. So I wanted to share that with you as far as if you have ideas that you've been testing, if you have a system that you trade that is profitable but you're concerned about its reliability, or if you need to rethink things. If you've gone through that process and you feel like it's based on a real market edge, then you should feel comfortable in it. If you feel like you're just trying to test every last idea you can come up with, I'll encourage you to take a step back and go back, observe the market, think about, by watching the charts, watching the market, watching the way things behave, and model it, and then come up with a very simple description of what it is about that edge that you can implement for yourself.